Morning, class. I think we are ready to start today's session, and we are continuing with fixed income. A relatively easy session on the block today. I think we are trying to cover up a couple of things that we left over yesterday, which was effective convexity and effective duration. And from effective convexity and duration, we'll effectively move towards credit analysis as a concept. I think that is one thing that is again pending from the perspective of fixed income. So the first part of the session should be uh, a bit of quantitative, and once we head towards the second half of the session, I think it should be relatively theoretical to that extent because credit analysis is more theoretical as a concept to cover than anything else. Perfect. I think with that background, I think let's just roll forward in terms of our discussion today. Yep. So we are now talking about curve-based financial fixed income risk measures. So when we say curve-based risk measures, the keyword here is curve, and we are looking at a curve-based measure, which means we are trying to focus on benchmark yield curve. Now, whenever someone says a benchmark yield curve, we are largely looking at what is the government bond yield curve looking like, what is the government bond rates looking like, right? A benchmark generally is government. A lot of people will benchmark it to the government, and based on the benchmark yields, based on how the government bond yields work, a lot of other bonds are priced, right? So, for example, government, as we said, is risk free. We consider it risk free. So, if government is risk free, all other corporate bonds will be slightly riskier, and we are going to obviously add a small spread every time we try and price in some other bond for our purposes. So benchmark yield curve is the starting point for a lot of reference. Now, yesterday when we were discussing duration and convexity, we said duration and convexity can be based on yields or can be based on benchmark curve. There are yield durations and there is curve based duration. The difference for some of you who missed the session yesterday, and if you were not able to attend, I think it would be a request just try and watch the videos as well, so that would help you cover up convexity and duration, because I think that was a fairly important concept to be covered from a exam perspective, and even from a practical standpoint, convexity and duration is something which a lot of debt market mutual funds or bond mutual funds will typically talk about. So there were two types of duration or convexity. One which you use for plain vanilla instruments, plain vanilla bonds, which is your normal yield based durations, and then there yield based convexity, and then there is curve, which means we are going to talk about embedded option bonds, right? So I'm sorry. Okay, why is my pen behaving a bit weird today? Da, 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 da. Hmm. Just a minute. I think the pen is not functional for me. Why? Pankaj sir, do you have any insights why the pen may get stuck?
Sir, I think replug the things.
Yeah,
It
we've
will be
plugged
easier
the
then.
no, no, we've plugged the things correctly. I think I just have to check why is this not functional.
Like, while plugging, it may ask you some permission. Yes, no.
It doesn't look like so because it's a standard when I do it every day. Let me just give it a shot again. Hmm, just a minute. Hmm, class, give me a minute. Let me just try and figure this out. The XT pen is also available at my end. That should not be a problem. Okay, perfect. Let's try this now. Okay. I think there is something which is not working
Uh,
for the pen
are you getting
pointer
option to
options.
select pen?
No,
Are you
no, no,
getting?
I'm not. No, 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 I'm not getting an option to select the pen. The command is currently disabled. Oh, got it, got it, got it, got it, got it. Sorry, sorry, sorry. Let me just make the document an editable document. Yep, perfect. Okay, so we are talking about now curve-based concepts and why is the need? Why do we need to learn effective duration or why do we need to learn effective convexity? The two terms that we are going to focus on today for our discussion purposes. Well, the primary reason why we have to focus on effective convexity and effective duration as a concept is because there are certain bonds which have embedded options. And if you remember, we said there are bonds with embedded options which include callable, putable, and at times your convertible bonds along with mortgage-backed securities. The primary differentiating factor between an embedded option bond and a normal bond or a plain vanilla bond is the fact that embedded option bonds can retire prematurely, right? You can call them or you can sell them back to the company by using a putable option. So if these bonds retire before maturity, right? If these bonds retire before maturity, then there is nothing like a YTM. There is nothing like a yield to maturity because you're not even hitting maturity. You are retiring before maturity. And if there's no yield to maturity, it's very difficult for us to use concepts based on YTM, like approximate modified duration, which we yesterday saw is based on YTM. So now what do we do? If I can't estimate a YTM, I cannot estimate approximate modified duration. So the simple answer is I will use an effective duration. If you compare the two formulas, nothing changes beyond this number. Instead of calling it a change in YTM, delta YTM, we call it a change in curve. And the change in curve is basically the change in a benchmark yield curve. So we don't largely bother about what is the change from the perspective of the YTM because YTM is difficult to calculate itself here, right? You don't know what the YTM will be because the bond will not be outstanding till maturity. So we focus purely on the curve matrix. How much has the government bond yield curve moved? Now, how does a government bond yield curve look like, right? So because we have been talking so much around government bond yield curve, let me just quickly put up a government bond yield curve for you on your screens. So let's just look at a government bond yield curve. Right, perfect. So if you try and look at US Treasury, right? I think US Treasury is your best shot if you want to look at how a government bond yield curve will look like. So this is US Department of Treasury website, and this is where you see there's a curve that we are looking at, and this is the yield curve. Now on the yield curve, let's say I'm going to look at current month. Okay, so current month, this is what we are looking at November. Now in November, if you see, there are different maturities of a bond, right? There 1 month bond, 1.5 month bond, 2, 3, 4 month bond, 30-year bonds. There are different maturities associated with bonds here. And with each maturity, you have different yield, right? You see, these are all percentage numbers. These are all yield numbers associated to those bonds. So this is what we call as a yield curve. And if I pick these numbers, let's say if I simply pick any of this number, let's say I just pick the first date. Okay, I'll just copy this. And if you model it on an Excel, the curve that you are going to see is called as your bond yield curve. So every time when I say a bond yield curve or if I say a benchmark yield curve, government bonds are considered benchmark. Yields on those bonds are benchmark yields. And the curve or the graph that you are going to draw using all the yields, different maturities, is a benchmark yield curve largely because we are going to use that word again and again. So it's important to understand and visualize how that benchmark yield curve will look like. So from our perspective, a benchmark yield curve, if I'm going to just look at it for the first date that we selected, which is I think November 3. My system is behaving pretty slow today. Yep. Okay. And let's say if I model this straight away from a maturity standpoint, this is what it looks like. And if you're going to just model a line graph out of it, this is the benchmark yield curve that we are looking at. So we are saying that in short term, 1 month, 1.5 month, 2 month, 3 month, the yields are decreasing till it goes to 1 year. But after 1 year, the yields increase because the risk increases from a bond market perspective. So that's typically the way a bond market yield curve will look like. And it doesn't change a lot, right? It's not as if that interest rates will suddenly change, right? Interest rates are pretty stable to that extent and they don't change overnight or they don't change instantaneously. If for that matter, if you want to look at how the yields are on 11/21, the last data available with us, and just for a comparison purposes, if we put that data here, and let's say if we model both of them, this will simply showcase how the yield curve has moved between these two dates. And if you see, there is not a lot of movement. There's a marginal movement on the yield curve. Not at all, I think something which is going to bother you a lot. Right? You can simply say start at 3.5% so that I can have a better understanding how the yield curve have moved. Right? So yield curves don't move very large. They show very, very small movement. And this is how the yield curve has moved throughout the last 17, 18 days in US market. Short-term rates are higher, around 4%. By the time you hit 2 year, 3 year, they are around 3 and 3.5%. And then they start again increasing because the risk starts increasing over a longer time period. So this is benchmark yield curve again and again. When we use it on the slides, I think you should be aware about what we are talking about. So we are saying your approximate duration is nothing but a function of v minus minus v plus upon 2 times v0 into del curve. How much is the bond yield curve changing? So if it was 4.5% and now it is 4.7%, the del curve is 0.2% positive. The yields have increased from 4.5 to 4.7%. Similarly, we have an effective convexity as a concept. And on effective convexity also, yesterday we talked about approximate convexity, which was based on yields or YTM, yield to maturity. Now today, because we are saying again, YTM is not practically feasible for some of these instruments, we will use it using a curve. So we simply replace the YTM with a curve and you can calculate convexity accordingly for a different data point or data set here. So that's fundamentally, I think, the way things are going to work for us on the yield-based measures, right? Or the curve-based measures rather, not the yield-based measures. Yield-based measures are yield to maturity-based measures. Curve-based measures are more, effective convexity and effective duration. Remember, these are used only for embedded option bonds. What are these embedded option bonds that we are looking at? So this is something we have discussed previously and we are reiterating the point. Embedded option bonds, the first one on our list is a callable bond. And I think we have talked about this graph several times. I've tried to draw this for you, but this is, I think, a very good representation of that graph. The red line represents normal fixed income bond market graph. The red line indicates as the yields increase, the price of the bond decreases, right? So you keep increasing the yields, the price of the bond will keep decreasing. These arrows will keep telling you that the price is going down, down, and down. However, if the yields decrease, the price of the bond will increase, right? So the blue line tells you that if yields decrease, the price of the bond starts increasing. But because this is a callable bond, the price does not go above the call price. So after a moment of time, the price doesn't increase, rather it flats out like this. So straight bond is your normal bond graph and callable bond or the callable bond graph is the graph which has a negative convexity or a lower duration. So in general, if we are trying to look at this, we are trying to say that the graph of a callable bond will have a negative convexity. And apart from that, the straight bond obviously has a convex curve and typically represents a positive convexity as a concept. There's also a lower duration for callable bonds because these bonds will typically be called before maturity and generally called earlier than the normal bonds. And the difference between the price on the normal bond and the price on the callable bond is your option value, call option value. Perfect. So value of normal bonds or straight bonds minus value of callable bonds is the value of call option. Similarly, a putable bond where you have a straight bond and a putable bond, but putable bond will sell at a higher value. Because it is putable, you can sell it to the company at a value higher than the normal value. The normal value could be P1, your value could be P2. The difference between the two is your put option value. It is valuable for you to hold this put option. These bonds have greater convexity and again lower duration because they again get premature withdrawals, but greater convexity because the graph behaves in a way where your convexity actually increases. So putable bond has a floor. I think if you want to look at it, this is the way the callable bonds have a cap on price. They don't increase beyond a point. While putable bond has a floor on price, which means they don't fall beyond a price. While callable bonds don't increase beyond a price, they go like this. Right? So there is a standard cap, which means maximum, floor means minimum. So these are two embedded option bonds which will need effective duration, effective convexity as concepts. Let's calculate quickly an effective duration. Now, for a callable bond which has current price of 101.06, when the curvature changes by 25 basis point, the prices are. So you have been given data already, right? So in this case, the life is really easy. They've given you current price. Current price is V0. So you know what is V0, 101.06. They have told curvature change 25 basis points. So this is 25 basis points, which is equal to 0.25 percentage. Right? Yesterday we did talk about the point that 100 basis points is equal to 1%. And accordingly, you should be able to convert basis points into percentage if required. V minus value of bond when yield decreases. Right? So if yield will decrease, the value of the bond will increase. So this is V minus, the value of the bond goes higher. And V plus, value of bond when yields decrease, or yields increase rather. Decrease is done. This is V plus. Plus means it's a yield increase. And if yield is going to increase, value is going to fall. So this is your V plus. You have everything available to calculate an effective convexity or effective duration, right? It's an easy setup. You don't have to do any V minus V plus calculation. You just have to plug everything in and calculate the numbers. All good? Does that help? Questions? Okay, perfect. It's a straight one, I think, because you already have data available, so you just have to plug it into the formula. But that is what I think level one generally expects a lot of times for you to do. For you to have an understanding what the data is, how the data can be used, and how you can decipher the relevant information from it. So V minus minus V plus 2 times V0 delta y, your effective duration is 7.60. Effective convexity, very similar. The only point is, the notations and the nomenclature is exactly the same. We use del curve square because we are saying the curvature is changing by 25 basis point, and this is a callable bond. I'm going to use an effective convexity concept, right? So this header should be effective convexity. And plugging in all these numbers, effective convexity comes out to be minus 283. Again, straightforward. In case V minus V plus is not given to you, then you will have to estimate V minus V plus. We talked about it yesterday. You will have to do your bond calculations on your calculators and estimate V minus V plus as numbers. What happens to your numbers if yields increase, and what happens to the numbers if yields decrease? We did it for everyone who was around yesterday. I'll quickly do a quick math for you around this so that at least we are on the same page and you are aware about what we are talking about. So let me just quickly get that calculator up for you. Perfect. So in this question, if you see, uh, oh, they've not given us actually data related to number of years and coupons. So we can't calculate V minus V plus. We've been only given current price. Yeah, perfect. So in this question, I don't think we can do a calculation. We just have to rely on the data. But if required, you can do your calculations. You can just put all these elements here. And what is only going to change is I by Y. The yield is going to increase and decrease by the same amount. Let's say quarter percent, half a percent, 1%, and then you're going to obviously model it using those elements or those numbers. Otherwise, all the other variables will remain the same, and you have to calculate obviously the price of the bond, PV. So in this case, obviously we can't because we don't have data to do that calculation. But let's take V minus V plus on the face value like they've been given to us. Let's take another example. BRWA's 5-year 3.2% semi-annual bond is priced at par and has duration and convexity numbers 4.8 and 40. Now, where do we use this? And those who missed the class, this is for you, the yesterday's session. The percentage change in price, how much will be the change in price of a bond, right? How much bonds price will change can be calculated using these two numbers, duration and convexity. So we can say minus duration of 4.816 multiplied by change in YTM, which means compute the change in yield for a 100% basis point increase and decrease in benchmark curve. So we are saying, okay, this is what I think my numbers would look like. And based on these numbers, I would like to calculate what is the impact or what is the solution for my percentage change in price of the bond. Now, in this case, we also have to look at conceptually how to apply the curve or the yield concept. In this case, we don't have this is what semi-annual bond. Yeah, perfect. This is semi-annual bond. So they're saying based on 100 basis points increase in 100 basis point increase or decrease in the benchmark curve. So if it's 100 basis point increase or decrease in benchmark curve, that is 1% that we are talking about as a fundamental concept here, plus half of 40, which is your annual convexity, multiplied by 1% square. This will effectively tell you how much will be the change in price. This should be change in price. This will tell you how much is the change in price for a 100 basis point increase or decrease in the benchmark curve. We're assuming if the curve moves by 1%, your yields are also moving by 1%. So it's a simple application of how much will my price increase or decrease if yields increase or decrease by 1%. And if we are going to do decrease, this is 1% increase. If you're going to do 1% decrease, nothing changes barring the sign. This will be minus 1%. Simple. Just put that minus 1% because your change is minus 1%. Yields are decreasing. And you will get to know how much is the effective change in the price of the bond. So the equation is fairly important from a exam perspective to estimate the change in price of a bond. You can use both convexity and duration. There you go. Look at this. Increase in yield, decrease in price. Decrease in yield, increase in price. And which is what I think we were trying to tell always, that the graph is inversely related. Price is inversely related to yield. So if yields increase, price decreases, and so on, so forth. This equation we covered yesterday to estimate the price of a bond. If convexity is not given to you, then you can ignore this part of the equation and you can simply solve for the remaining part of the equation, which is percentage changes in prices minus duration into YTM. But if convexity is given to you, that is part of your calculations to that extent. Okay, perfect. Then we move towards what is the key rate duration. Now, in level one, for key rate duration, there's only theory. So this is the concept which is only theoretical. Barring this, yesterday we talked about Macaulay, we talked about modified, we talked about approximate modified, then we talked about obviously money duration, and we talked about PVBP. This plus today's effective duration, all of these have numericals. So there's a possibility you could be tested on math and theory on these durations, but key rate is only theoretical concept. And obviously we did a portfolio duration also yesterday. So what is key rate duration? Well, effective duration assumes parallel shift in benchmark yield curve regardless of maturity, while non-parallel shifts can be measured using key rate duration. And in reality, the shift in curve is non-parallel. It is not parallel shift in yield curve, right? If you look at our Excel sheet, you will notice that the change between each of these years is not the same, right? For each maturity, the change is not the same. Classical example, 1 month, the change is 0.03. For other months, it is 0.08, 0.04, 0.05, 0.9. So there are different changes. It is not changing by the same amount. Parallel shift is, if I tell you that from November 3 till today, all the yields have increased by 0.05. This is parallel shift. And now you see the graphs don't intersect each other. They are parallel. They just keep running. They do not intersect each other. But in reality, the shift is seldom parallel, right? There is a possibility that the shift or the curves are non-parallel movement, which means every yield changes by a different amount. So if yields are changing by a different amount, you cannot always say that effective duration is the best because effective duration assumes parallel shifts. This is where we need key rate duration. Key rate duration helps you measure non-parallel shifts from a duration perspective. From an empirical duration perspective, all duration measures seen so far are analytical durations. Empirical durations use observed relationships instead. So whatever we have done is calculation or estimation of duration. Empirical is something which is based on historical data, right? Based on historical data, what the duration would look like. But again, theoretical to that extent, I think don't expect a lot of questions on key rate or empirical. On key rate, I think parallel versus non-parallel is something you should remember. Key rate duration helps you measure non-parallel shifts in yield curve. Actually, a quick, let's give this a try. When comparing analytical duration and empirical duration, which of the following statement is correct? Empirical duration and convexity are estimated duration and convexity statistics using mathematical formula. Analytical are estimated using historical data in non-statistical models. So both of them are actually incorrect. They are reverse. Analytical is based on estimation of duration and convexity using formulas. So whatever we are doing are analytical, right? The formulas applying V minus, V plus, all of that is analytical. While empirical is estimated using historical data in non-statistical models, right? So empirical is more about, you know, looking forward and figuring out, okay, what data is better. Is observing historical relationships. It's not calculating anything. So in this case, because it is asking which of them is correct, neither A nor B. The right answer is C. So this was, I think, the leftover portion from our convexity duration session, which we started yesterday and gave a lot of time to convexity duration yesterday. Now, before we move to credit risk, questions, anything? Okay, perfect then. No issues. Let's start credit risk in just 1 minute. I'll get a glass of water for myself, and I think we'll start credit risk right after that. Perfect. So excuse me for a minute, and I'll be back. Okay, perfect. So we'll start with credit risk now. What is credit risk? As the word suggests, I think credit risk is about the risk of default, and this is where a lot of companies operate and provide credit assessment reports, right? So I think you might have heard about businesses like S&P, Moody's, Fitch. I think these are the three large US credit rating agencies, right? So Standards and Poor, Fitch, and Moody's. Obviously, these are the larger ones, but again, there are other entities, or there are new rating firms like Morningstar, DBS. A lot of them are doing credit rating. In India, obviously, we have companies like CRISIL, CARE, ICRA, and India Ratings nowadays, SMFG. Some of these businesses in India also do credit rating analysis. And credit risk is what all of them are trying to assess. Credit risk is nothing but the risk of default. Uh, how do you assess a credit risk? What are the elements of a credit risk is something that the reading focuses on. Now, when we say credit risk, as I said, it is the risk of loss as a result of borrower failing to make full and timely payments, right? So, and which is the reality at times, right? All the non-performing assets that we look into are as a result of credit risk. There is a borrower who borrowed money, and the borrower is unable to repay the money back. So, all that leads to a credit risk element or the risk of a default. Now, it has two components, right? Whenever you talk about a credit risk will typically have two components. One, default risk or probability, which is what is the probability that the borrower will default. Now, please understand, whenever a company gets into a lending activity, like let's say it's a bank, right? So a bank is lending money. The bank is in a business of lending money, and the bank has to take risk. Every lending comes with its own risk. That doesn't mean the bank will stop lending because that is their core business. So they assign a default risk or a probability that the borrower will default. Now, the point is, if the borrower defaults, what is the loss severity? It is a portion of the bond's value that the investor loses. For example, 45% of loss severity would mean 55% of the principal is not returned by the borrower. That 55% can be termed as the recovery rate. So we are saying expected loss is equal to default probability into loss severity. So if I say there is a 50% chance of default and there is a 30% loss severity, I am looking at a loss of around 15%. However, if the borrower defaults completely, then my loss will also go up because now there's 100% probability this guy is not going to pay. And if the guy is not going to pay, I'm going to lose out the 30% of the money which I think I will not be able to recover. So 100% probability of losing 30% capital. So expected loss is a function of default risk or probability and loss severity. These probabilities are again based on empirical evidences, based on observations in a sector. Generally, you can't ascribe a lot of quantitative mathematics to the probabilities, but it's more of a probability. It's more of an estimate. What do you think will happen with this lending arrangement that you have done? In this category of credit risk, your credit risk can be bifurcated into three different elements. First is spread risk, the difference between the yield of a risky bond and a non-risky bond is termed as spread risk. So yield on a triple C bond, right? A company's bond which is the rated triple C. Yield on a triple C bond, let's say, is 11.5%. And yield on a risk-free bond, which is a government bond, let's say, is 4.5%. The difference of the two, 7%, is your spread risk. The difference between the yield of a risky bond and a non-risky bond is termed as a spread risk. Now, higher the risk of your bond, higher will be the spread. Triple C bonds will be, for example, 11-12%. Triple B bonds will be around 7-8%. So as your rating keeps improving, your yields also keep reducing because now you're not as risky as before. Then there is a risk of credit migration or downgrade. This is the risk of issuers' creditworthiness deteriorating, leading to a rating downgrade and making investors believe the risk of default is higher. So when I gave you the loan, your rating was AA, right? But today your rating is B. You have seen a downgrade in your rating. Why did you see a downgrade? Because of certain business events, certain things not going in your favor, your credit rating gets downgraded. And if credit rating gets downgraded, that also leads to a higher risk of default. This is known as downgrade risk because now the issuer is downgraded, there is a higher risk of default. It nowhere says there will be a default. It always says there is a probability of a default that can happen, but it is not a guarantee that a default will be there. Then there is a market liquidity risk. Sometimes the price at which investors can actually transact might differ from the price indicated in the market as a result of insufficient liquidity. And this happens even in equity markets, right? You want to sell a security, but there's no major liquidity. Then what happens by the time you place your order and the price at which your order gets executed may be different. And that is called as market liquidity risk. Remember, market liquidity risk is purely on account of insufficient liquidity in the market. There are not a lot of buyers and sellers. Credit migration or downgrade risk is more or less due to rating downgrades. And spread risk is based on the riskiness of the bond. So these three elements combiningly contribute to what is called as credit risk, right? You will have to assess these elements before you can answer what is credit risk concept. Questions? Anything on any of these three elements of risk? Okay. Remember, these are the building blocks of credit risk. If we are not able to understand the building blocks of credit risk, at times it becomes a problematic scenario to understand what credit risk is trying to encapsulate in itself. Now, when we look at credit risk, obviously seniority of an instrument is very important. When I say seniority, step one is capital structure. This is the structure of a company's or institute's liabilities. It is composed of debt, preference shares, and equity shares. In a capital structure, debt is the senior, preference is in between, and equity is the most junior security. So the risk of debt is lowest and the risk of equity is the highest. Now, within capital structure, you could have seniority rankings, which means it represents priority of claim. Priority state starting with the most senior or highest ranking debt, having the first claim on the cash flow and the assets of the issuer as compared to a junior debt. So when we say secured debt, direct claim by debt holder on issuer's assets cash flow and has a priority of claim. So if you are a secured lender, you have direct claim on the assets cash flow, whatever the company assets are on the cash flows of that asset. And obviously you have a priority of claim. You get your payments first. If it's an unsecured debt, you have only a general claim. You cannot have a asset based claim. So you cannot say that, okay, this asset is something that I'm looking at. You will have a general claim, which means if there's anything left over after paying secured debt, unsecured debt will be given the money. And therefore it ranks below in case of default. It comes after secured debt in terms of default. Then in this category also comes first mortgage debt. Includes pledge of a specific property like power plant. It is a mortgage debt. Mortgage debt means it's a loan based on a mortgage. I've given you a real estate property as a collateral. That could be a plant, that could be a real estate, residential complex, whatever it is. But there's a real estate backing the loan. First lien debt includes pledge of certain assets like patents and licenses. What is pledge? Pledge is basically the company giving you the asset that in case if I am unable to pay the loan, you can sell the asset and you can recover the money. So pledge is as good as telling the company that okay, the asset you can sell and recover the money if I am unable to repay. Subordinate debt, it includes the junior debt which might have little or no recovery in case of default. That is why it is called subordinate or junior debt, because there may not be a there may be a possibility where now no money is left for the subordinate debt or the junior debt. There's a real time possibility that can happen. So you could have all of them, and within subordinate also you could have senior subordinate, subordinate, junior subordinate. You can create hierarchies. So it's not something which is a problem to that extent. It's a customizable arrangement. But yes, higher the seniority in the ranking, lesser the probability of default. Clear? Questions? Okay. Recovery rates, as we said, is 1 minus loss severity. If loss severity is 45%, recovery rate is 55%, which means you've recovered 55% of the money. Now, this is what you might have also seen in a lot of Indian, context. We nowadays have something called as an IBC, Insolvency Bankruptcy Code. Okay. The Insolvency Bankruptcy Code resolves a lot of bankruptcy related cases nowadays in India. And that is where they look at recovery rate. Whom should we give the asset? We should give the asset to someone who offers us highest recovery rate. Like I think last week you might have heard about Jayaprakash Associates. JP Associates, as in assets for JP Associates were given to Adani Group. Adani Group made some payments and they got JP Associates assets as a business. Obviously, for bank, the important point is instead of losing 100%, the banks lost, let's say 60%. They got 40% of the money back or for 45% of the money back, whatever that number is. So rather than losing everything, they just lost, let's say 40, 50%, 60% of the money here. Clear? Now, in this case, where we say recovery rates are 1 minus loss severity, and I'm sorry, I have to just look at where is the chat box. At times I miss the chat box, and there may be questions from you on the chat box. No? Okay, perfect. Yep, that's fine. So there comes a term called pari passu. Now, pari passu means equal rights. If I say all of us have shares in a company and those shares have pari passu rights. Pari passu rights means your and my rights and preferences are the same. There's no difference between your rights and my rights to that extent. So all the creditors with same capital structure are treated as one class. For example, a senior unsecured bondholder whose debt is due in 10 years has the same pro rata claim in bankruptcy as another senior unsecured bondholder whose debt matures in 3 months. So if we are similar type of securities, our rights and preferences should be similar, and that is called as pari passu. And as I think the slide says, the provision is referred to as bonds ranking pari passu which means on equal footing. Then comes recovery rates. There are a few things pertaining to recovery rates worth noting. Recovery rates can vary widely by industry, and some industries may have lower recovery rates than the other industries. So, this again is based on the type of industry you're trying to work into. Like, typically you will see NPS, non-performing assets in industries like power, right? More non-performing assets relatively, steel. Again, a very problematic sector, shipping. So it is very, very industry specific. You don't find a lot of defaults or bankruptcies in a geography or in a industry like IT. So always remember that recovery rates can vary by industry. Recovery rates can also vary depending on when they occur in credit cycles. Think about it. Why? Why do they vary based on the credit cycle or maybe the economic cycle? Look, if you are in an expansionary economy, the economy is doing really good, then the recovery rates could be really high. Because if the economy is doing good, people are making money. And if people are making money, there should be no problem in repaying the money. But if you are at the bottom of a cycle, then recovery rates are generally lower. As in a recessionary environment, the business is anyways doing very bad. So the recovery rates tend to be very low on the recessionary end of the cycle. The recovery rates are averages, which means there can be a large variability in recovery rates across industries. Moreover, different companies have different debt structures. So the public data on recovery rates is an average of various industries and issues. You don't get sometimes industry specific data points. You generally get data points sometimes which are more generic in nature than being industry specific. So there's a possibility that you may not get industry specific data points. Credit rating agencies, as I said, the major rating agencies in US, given we are focused on a US based program, is Moody's, Standards and Poor's, and Fitch. I think those are the large credit rating agencies that we are looking at. They're primarily, I think, the leaders in that market in US to an extent. There is debate whether they are honest, whether they do their work with full integrity, so on and so forth. That is a debate for some other day, possibly, because you'll read around a lot that credit rating agencies are hand in hand with the clients, and they generally may offer client benefits because of the nature of the business. It's a conflict of interest business. Please understand. I'm going to make a payment to you, and I'm going to ask you to do a credit rating report for my company. And if I'm going to make a payment to you to do that report, obviously there is a bias that gets created at your end. There's obviously a conflict of interest that we are looking at from your perspective. So I don't know how good or how independent these reports will be. They are expected to be independent. Credit rating agencies are expected to have an independent analysis, but there's always a debate. Do they do their work independently? It's like auditors, right? All of us expect auditors to do great work. We expect auditors to be independent. Auditors are paid a fee for accounting, auditing, all of those things. However, auditors can become friend of the company, right? And no one stops that, which can be a problem. But for now, we'll assume that all these CRAs, Moody's, Fitch, and S&P, do a reasonably good job in doing credit rating. They are getting prominence due to independent assessment of credit risk. Yes, they are expected to be independent. There should be an independent assessment of credit risk. Ease of comparison across bond issuers, issues, and market segment. Regulatory and statutory reliance and usage. Sometimes it's mandatory to get a credit rating done for you to take a loan from a commercial institute or from a bank. So then it is mandatory that you have to get a credit rating done for your business. Regulatory and statutory reliance and usage, as we said, payment by issuer for rating. So the company makes that payment. Oops. I'm sorry. Yeah. So the company does make that payment in terms of the credit rating reports, and which makes it slightly trickier as a concept. Are they fair enough? Are they honest while providing credit ratings? Development and expansion of bond portfolio management and accompanying bond index. Now, because there are so many bonds in the market, and as we talked about previously, also the bond market is larger as compared to equity market in the West. And if there are so many bonds in the market, there are so much dollars which are flowing into bond investments. The investors are keen on understanding what is the rating of the bond that they are buying, and which is where these rating agencies are expected to work and provide an independent rating. With exceptions of the subprime mortgage crisis, which is your 2008-9, rating agencies have shown that they do a good job rating debt. However, there are risks involved in relying solely on these agencies. First, credit ratings can change over time, and ratings are not guaranteed, which means, let's say you are investing today or you are planning to buy the bond today. Today, the credit rating of your company is AAA and you bought the bond. But after maybe, let's say, 3 years, the credit rating becomes C or a double B, and now your bond is more risky. So, this can happen. Credit ratings can change over time. Credit ratings tend to lag the market's pricing of risk. This is, I think, the biggest disadvantage. Credit rating agencies are presumably a lag indicator. What do we mean when we say a lag indicator? They generally react at the last, right? And by that time, a lot of damage has already been done. So I don't know what should I do with their reports. Classical example, Yes Bank was a AAA rated security. By the time credit rating agencies came out and wrote a report that Yes Bank is a D rated security or a C rated security or a B rated security, a lot of damage was already done to the stock price. So I don't know what should I do with the credit rating report then. So they are lag in terms of market. And rating agencies may make mistakes. Some risks are difficult to capture in credit ratings. So it's always subject to errors. Questions? Okay. Now, what are the type of ratings and how can you improve ratings? First, issuer and issue. Issuer credit rating means it's a corporate family rating, which means this is the rating of the company. So, for example, rating of Reliance Industries is issuer rating. That Reliance is rated AAA. That is their family rating. However, issue credit rating is specific to a issuer's project. For example, the Jamnagar refinery of Reliance. Now, the refinery is different from Reliance Industries. Refinery is a project, while Reliance Industries is a business. So, when we say Jamnagar refinery, the rating of the refinery could be AA, while the parent rating could be AAA. There is a possibility this may happen. This is issue rating. The first one is an issuer rating. You have to understand why. The issuer is generally having multiple projects. Reliance has multiple projects, multiple avenues. Even if one project goes bad, Reliance is not materially impacted. It is diversified. But if you have given to loan to Jamnagar refinery, you have to ensure nothing happens to refinery, because there's if any problem to refinery, there is no, backup plan for you. There is no what is called as diversification for you as an investor. You have bet all your money on one single project, which is why projects are generally inherently more riskier as compared to betting on a business. Then there are cross default provisions. If interest or principal payments are not serviced for one debt, then it triggers default on all debt. Now, this is interesting. This is what is a type of covenant. If you remember covenants, we said covenants are rules and regulations which debt holders bring. So, if I have given a loan to the company, I can bring in this cross default provision and I can tell the company, look, if you don't make my payments on time and if you default on any of my payment, that will automatically trigger repayment of all the remaining debt of anyone, right? You will have to pay payments to all your debt holders if you don't pay me. That is a condition. If you want to sign the agreement of debt, otherwise don't sign. Now, the company therefore will be ensuring that my payments are done and there is no cross default because they are already low on cash. They were not able to pay my cash payments or my principal payments and interest payments. And if I ask them to make the payments for all other debt issues, there will be a major liquidity crunch at the end of the business. Then there is a concept of notching. What is notching? Notching is taking the rating higher or lower, right? So notching basically says, let's say a company gets a rating of A. Now they want to make it double A. What is the possible solution? They want to increase their credit rating from A to double A. This is called as notch, right? You are moving one notch higher. You want to take your rating one notch above. There could be several ways to do this notching, right? So I think how will we achieve this? One simple example is uh, the company's parent can give a guarantee, which is called as corporate guarantee. So if Jamnagar Refinery is getting an A, Reliance Industries can give a guarantee on behalf of the business and say if Reliance doesn't pay, we will pay. And in this case, the Jamnagar refinery may not have the money, but Reliance Industries would be readily available to make that payment. This is where we say Reliance Industries has reduced the risk of Jamnagar refinery by providing a guarantee. And because of this guarantee, the rating has moved from A to double A, one notch higher for the Jamnagar refinery. If Reliance does not provide this guarantee, there is a risk that if the refinery fails, what happens to your money? So notching is basically a process by which you can increase or decrease the ratings. And it could be both sides, notch higher or notch lower. Now, structural subordination is another way to implement some of these things, where you can say debt of a subsidiary would get serviced by the subsidiary before funds could be passed on to the parent, right? So you're blocking the subsidiary. You are saying the subsidiary cannot transfer funds to the parent without making my payments. In this case, you have made the parent's loan as subordinate. You have said, okay, parent, you will get money after me. And if that is the case, you are structurally subordinate to me in that capital structure. Okay, do we understand notching? I think notching is more important. Okay. So formulas, as we discussed, I think these are more or less the formulas which we discussed: expected loss, probability of default into loss given default. Recovery rate, obviously the amount that you will recover, which is equal to 1 minus loss severity, or loss severity is equal to 1 minus expected recovery rate. So you can write it both ways. Expected recovery rate is 1 minus loss severity. Exposure amount investor owed minus the value of the collateral available. There's a possibility your collateral value is very high. You've taken a loan of 100 crore, but your value of the collateral is 120 crore. In that case, the exposure for the lender is zero, because he has such a big collateral that he can sell the collateral and recover all the money. Loss given default, expected loss into 1 minus recovery rate and credit spread. So it's more or less mathematical to that extent. You'll have to obviously remember formulas to solve for them. Give this a try. Give it a try. Let us just keep the formulas for you on your screen, and I'll also keep the data for you. BRWA issued an unsecured 5-year bond with 3.2% fixed coupon. This credit spread over US Treasury bond is 90 basis point. G spread. Remember the government spread. This is telling you that if corporate bond is trading at 3.2% fixed coupon, the yields or the spread on Treasury bond is 90 basis point. Given a probability of default of 1% and a loss given default of 80%, are BRWA's investors adequately compensated? Now remember, we just read an equation. Credit spread is probability of default into loss given default percentage, right? Credit spread is probability of default into loss given default percentage. Our probability of default is 1% and loss given default is 80%. Perfect. That is what our data looks like. Where is, yep, 1 and 80%. So if 1 and 80% is this, credit spread is 0.8%. 0.8% should be added on top of GSEC or the government bond. So answer the second part of the question. The first one I've done for you. Are BRWA's investors adequately compensated if the credit spread is 0.8%? You have all the numbers on your screen. You just have to apply the data and work through this. Remember, your credit spread is 0.8%. However, how much are you adding on your treasury security? 90, which is 0.9%. Therefore, you are actually off covering them for 0.1% more. So yes, the investors are adequately compensated. If the US Treasury bond spread would have been only 0.5%, or 1/4%, we would have said there is a problem. But at 90 basis point, it is something which is good from an investor perspective, that you still have buffer of 10 basis point. All good? No questions? Okay, give this a try, please, then. If no questions, give this a try. Vivo has issued a 5-year, 6.5% non-callable bond at par. You have a coupon, you have a time, with probability of default at 6% and loss given default at of 50%. Once again, I think it's more of a formula game. Now, on expected loss was equal to probability of default 6% multiplied by loss given default of 50%, which means you are going to lose 3%. If there is a loss, you're going to lose 3%. How much should be my credit spread? If the expected loss is 3%, how much should be my credit spread? Remember the formula we just read? Credit spread is equal to probability of default, which in this case is 6%, multiplied by loss given default. So 6% into 3%, there is not a lot of difference. You will still end up with a credit spread of around 3%. And therefore, we say that the credit spread should be 3%, and you are charging a credit spread of 4.2%. So investors are again adequately compensated. You've taken care of their interest and you've charged a higher credit spread. So it's all about setting the math to that extent that, okay, we are able to compensate or not from an investor standpoint. Okay, one more question. Which of the following factors are associated with lower probability of default and higher credit quality for the issuer? Oh, this is easy. I think this is more of a qualitative question. Look, if all of them have high profitabilities, right? So that is not your deciding factor. The factor is, if high credit quality is what we are looking at and low probability of default, what are the numbers that we need? The answer typically would be low leverage. If there is lower leverage, that means you are a better company. Lower leverage means your debt equity ratio is lower. And if debt by equity ratio is lower, that is a benefit for you. So it has to be between B and C. Now, which of them is the correct one? For high credit quality, low leverage, and higher coverage ratio, your interest coverage ratio should be very high. So your answer should be C here, high profitability, higher coverage, and lower leverage. Perfect. Let's pick it up from our credit risk concepts and add additional inputs to this. Now, credit ratings, and I think we did see this previously when we were discussing a concept around investment grade and non-investment grade rating, right? So this is also called as non-investment grade or high yield ratings. The use of credit ratings obviously is more from a lending perspective. Before you lend money as a lender, you would like to understand what is the credit rating that will help you decide the spread. How much additional spread do you want to charge on the interest rate? This, in a way, helps you assess your credit migration risk also. Do you want to assess the risk and accordingly migrate or mitigate the risk? The comparison of rating happens across bond types, industries, and across the time. As we said, some industries are more risky, like steel, metals, because these are cyclical sectors. They are more impacted by economic cycles versus other sectors like pharma, which are more defensive sectors. They don't get impacted by economic cycles a lot. They are relatively more defensive. Then it also happens across bond types. For example, we've talked about a callable bond is more risky for an investor versus a normal bond, which is relatively less risky. And time. Credit rating again is based on time of borrowing or time of investment. How long is the investment going to be outstanding for? Classical example, which of the following statements most accurately characterizes best practices for the use of credit rating amongst analysts? Analysts can generally rely on credit ratings and ratings outlooks to predict the market price of credit risk. Analysts must incorporate credit ratings into their analysis to meet regulatory requirements. Analysts should conduct their own credit analysis as sole reliance on credit ratings to make investment decisions has several pitfalls. Now, if I'm going to talk about best practices, you can generally rely on credit ratings and outlooks to predict market risk of credit risk. Not necessarily. You will have to look at several other parameters as well. When you look at to meet regulatory requirements, it's not always that there is a regulatory requirement. You might still want to do a credit risk analysis. So the idea is only relying on this is a problem. You should do your own analysis also. And based on your own analysis, you should identify, okay, is this good or not from a lending perspective? Sorry. Now, which statement best describes the relationship between credit ratings and market pricing of risk? Credit ratings primarily seek to assess loss, while market pricing of risk for investment grade bonds is primarily focused on default timing and recovery rates. Credit rating outlooks tend to be more closely aligned with market conditions and credit ratings, and credit rating usually capture the market pricing of risk associated with debt financed acquisitions. So, yes, we do assess expected loss. We agree that this is right, that you assess expected loss. However, market pricing for distressed bond focuses on default timing and expected rates, so not on investment grade. Right? Investment grade bonds are anyways great bonds. They're good bonds, right? That is why they're called as investment grade bonds. They are high credit quality, triple A, double A rated securities. So if it's a distressed or high yield, then we are going to focus on investment or your default timing and expected recovery rates. So this is a statement which is incorrect to the extent. Which statement best describes the relationship between ratings and market pricing of risk? Credit ratings primarily seek to assess expected loss. We just talked about that. While market pricing, this is again, I think the same line put forward. So this is wrong. This is not best describing a relationship. Credit ratings usually capture the market pricing of credit risk associated with debt financed acquisitions, and credit rating outlooks tend to be more closely aligned with market conditions. Yeah, this is, I think, obviously, it is an outlook, right? So it talks about more closely in terms of what is happening in the market. Now, what type of risks along with credit risk are we trying to assess when we are doing this analysis? Please remember, the risk that we are trying to assess is also dependent on several other factors like macroeconomic factors. Now, what are these macroeconomic factors? Credit risk largely moves in line with economic cycles. As I said, if it is an expansionary cycle, the risk is less. If it is a recession, the risk is more. So this is correct. Generally, yield spreads increase with maturity. We have talked about it. The longer the maturity of a loan, higher the spread because the risk is also higher. You can run away after 8 years with my money, but in 8 days, I know what you're going to do, where you are. So it's easy to track you for 8 days than 8 years. Risk is higher for 8 years, and therefore the spread is higher. Dispersion of yield spreads for high yield issuer is higher than investment grade. Absolutely. For high yield, obviously the spreads will be larger because the risk is also very large. High yields tend to fluctuate more. They are more volatile. Why are they more volatile? Because the risk perception is also more. So if the risk is more, volatility is more. Volatility is more. We are talking standard deviation is also more. Fluctuations are more. Vis-a-vis issuer specific factors. Now, macroeconomic factors obviously is one driver of risk. But then there are issuer specific factors, which means company specific factors. Financial performance of issuer has large impact on the credit rating. Most of the credit rating agencies look at financial statements, and financial statements are thoroughly analyzed to provide a credit rating. So the performance of issuer has a very large impact, and the financial performance on the credit rating. Comparison of issuers yield spread to average spread for similar ratings is done. So if I'm going to say, you know what, double A rated bonds spread is, let's say, 1%, then I'm going to compare your yield spread to such bonds, and I'm going to try and assess, is your double A rated bond also trading at a very similar spread? If yes, no problems. But if your double A rated bond is trading at a spread higher than what the market spread is, then there is a concern. Either the rating is not accurate or the market is trying to price in some additional risk in the company. So it's always comparative study. How are your ratings versus market? If the market spread is 1%, is your spread also 1%? Is it higher or lower? Why is it higher? Why is it lower? That is what we will try and assess. And then market factors. Cost of trading a bond, wider bid-ask spreads, cost of trading, higher liquidity, all of this determines how does the risk for credit risk behaves. So credit risk is not only a function of the company, it is also a function of macroeconomic and market factors. Sometimes the company may be doing good on financial statements, but the economic factors are not supporting the industry, and that means that going forward the industry will be in a problem. There will be challenges that the industry may face, and this may lead to a lower rating to a certain extent. Sometimes industry dynamic changes. Sometimes the government regulations change, and that impacts the industry to a large extent. I think this is a question which is duration, convexity. Which change in credit spread results in a price decrease closest to 7.5%? Oh, perfect. Okay. So primarily you're going to put modified duration into the equation, minus 4. Remember the minus sign, into spread, plus half into convexity into spread square. Put these numbers one by one. Minus 1%, plus 1%, plus 2%. Minus 1% square, plus 1% square, plus 2% square. And they are asking price decrease. There's only one way price can decrease. Your price can only decrease if the spread increases. So out of these two, you will have to figure one right answer, and whichever gets you closest to 7.5% as percentage change in price of the bond is your answer. If that is 1% or 2% increase. Decrease obviously is not applicable, because if the spread decreases, yields decrease. And if yields decrease, the price will increase. So this option automatically is ruled out. You will have to just solve for both of them and see which of them leads you to a 7.5% decrease in price. Yep. So put a 2% here and you solve and you get a 7.5% decrease in price. So this is the spread that we are trying to look into. That if the spread goes up, the yields also go up, and if yields go up, the price of the bond will decrease. The equation has been borrowed from what we discussed in the morning and yesterday. This is modified duration and convexity blended together as a equation. Perfect. Questions? Anything? Before we move towards the last reading for today, which is credit analysis of government issuers. What we have been discussing for now is credit analysis for corporates, right? Private businesses, companies, corporates. For government issuers which are considered risk free, how do you do a credit analysis, and is it actually necessary? But before that, any other questions? Now, also remember, when you're doing credit analysis, a lot of people follow 4 C's of credit analysis. Capacity to pay. Before we get into government, this is important to understand. Capacity to pay, character of management, collateral that you provide, and covenants. These are called as 4 C's of credit rating or credit analysis. Can the company pay? You are going to assess their capacity to pay. What is the character of the management? Is the management good enough? Do they have corporate governance, clean corporate governance? Do have they in the past defaulted or made all their payments? All of this helps you understand, okay, is the credit rating going to be higher or lower? Collateral. Are you providing collateral when you are borrowing the loan, taking the loan or selling the bonds? If yes, obviously the credit rating will be better. And covenants. How stringent are the covenants or the rules and regulations from the lenders? So when you're doing credit rating analysis, I think these are the 4 C's of credit analysis that we would like to focus upon. Capacity to pay, character of management, collateral, and the covenant. Okay, let's talk about government issuers. Now, in the past, when we started fixed income, we did talk about government issuers, and we said it could be sovereign, which means the national government issues bonds to raise funds for public goods and services, and investments into public infrastructure. Then there could be non-sovereign, which are issued by states, provinces, countries. That should be countries, or other non-sovereign counties from a European market or US market perspective. This could be cities, right? And as I said earlier, California can do their own fundraise. You can have New York doing their own fundraise, because in that case, their cities or states do their independent fundraise. And entities created to fund and provide services can do their own fundraise. Remember, some of them are not government, they are non-sovereign in nature. Don't carry the full guarantee from the federal government or the central government, but they are non-sovereign, quasi, if you want to call it that way. Now, when government is issuing bonds, what are the factors that you have to assess while giving them the money and taking a bond from the market? Qualitative factors affecting creditworthiness of a government bond. Institution and policy. Which institution is issuing the debt? If it's RBI, a lot of people will be very comfortable buying anything from RBI. If it's, on the other hand, National Highway Authority of India, that's reasonably okay, but not as great as a quality as, RBI driven debt financing. And again, institutions may vary. Like we could have NABARD, which is agriculture bank. We could have SIDBI, small bank. So institution is important. In US, we have like Ginnie Mae, Fannie Mae, Freddie Mac. It all depends what is the institution's credit quality. Is fiscal flexibility there? Will the government be spending more? And will these institutions make more money? What is the monetary effectiveness? How is the interest rate scenario going to be playing out? Are interest rates going to be tightened from here, or are interest rates going to be relaxed? This all contributes to your economic flexibility. Is the economy in a phase where there's a strengthening economy, or you see there is an economy which is fragile? Because in a bad economy, a lot of institutions may collapse and dissolve or shut down. Will the government be able to rescue them? That is an interesting aspect to cover when you're doing government debt analysis. External status. How much is your debt as a country versus your GDP? And as I said, the character of the management, it's very similar to the willingness to pay. You may have the money, but there's no willingness to make the payment. In that case, the bond will be considered a very high yield bond, because the government is not willing to pay. Why do we call them qualitative? Because these are largely analyzed on a qualitative basis. You don't have a lot of quantification for this. What you can assess on a quantitative basis is fiscal strength. So you can look at what is the fiscal deficit, right? And if the fiscal deficit is more, the government will need more money. And more money means more borrowing. And if they're going to do more borrowing, obviously interest rates are going to increase. So we can measure fiscal strength. We can measure economic growth and stability using terms like GDP growth, and even external stability by looking at how much is your forex reserves, how much is your, you know, trade deficit, which is again a lot dependent on external factors also. Your import export is dependent on external factors as well. So in some of these cases, before we analyze government debt, we have to look at qualitative and quantitative factors. Sometimes, and most recently, I think I'm sure you would have heard a lot about the amount of bonds which the US government has sold to different geographies, in which I think the top holding for US government bonds is with Japan, followed by China. And that is a factor that you should always keep in mind in terms of external factors. What if tomorrow Japan and China start selling US bonds? Think about it. Trillions of dollars of US bonds will hit the market. And if so much supply of bonds come to the market, that would be a major financial problem for US as a market to handle so much supply in bond markets. Because if there's a lot of supply, the prices of the bond will start falling, yields will effectively start increasing, and increasing yield will lead to major issues for a lot of borrowers in the market. So sometimes your debt is not in your control also. You have basically given sort of a remote control to someone else, and they can control the US economy sitting in their own economy by just ordering, you know, dumping of billions and trillions of dollars of US government bonds in the market on the same time. Example, government of Romania's improved ratings outlook. So this is typically the way a ratings outlook will look. In October 21, Moody's Investor Services changed its rating outlook on government of Romania from negative to stable. Negative to stable means you are looking at improvement. Now, this improvement could be on several parameters. This could be based on better macroeconomic conditions, government policies, and so on and so forth. With BA3 issuer and senior unsecured debt rating. In addition to solid economic growth prospects, Moody cited an expectation of consistent and sustained fiscal consolidation. This is what even India is trying to do over several decades now. We are trying to ensure that our fiscal deficit ratio reduces gradually. Every budget, the finance minister will talk about what was the fiscal deficit last year and what are they targeting for next year, right? So are they trying to bring it down from 4% to 4 point, or from 3.9% to 3.5% to 3.2% and so on and so forth. But that is called as consolidation. Even a reduction in fiscal deficit is a great sign that your revenues are increasing and your expenses are getting controlled. As part of Romania's goal to become a full-fledged member state after joining the EU in 7, the government was expected to prepare and implement fiscal reforms to reduce its annual deficit to below 3% of GDP within 3 years. So even our government has such a roadmap that we want to take the number to X percentage in the next few years. It got temporarily, derailed because of whatever happened in 2020, 21, 22, because the COVID time frame. But the government is again on the path of a fiscal consolidation. The incentive to reduce the deficit was strengthened by the possible suspension of EU structural and investment grants in the case of non-compliance. So in this case, specifically, if you talk about Romania, EU will stop providing any investment grants and structural grants if you don't comply to European Union policies. But overall, this is how an outlook will look like. Generally, a lot of these, rating outlooks are published by these credit rating agencies and help you understand what an economy is doing. Another case in this category is Zambia's default in 2020. The Republic of Zambia defaulted on a $42.5 million euro bond payment in November 20, the first sovereign default following the COVID-19 pandemic. Zambia is Africa's second largest producer of copper, which comprises 60% of its exports. An economic slowdown due to COVID-19 accelerated a decline in copper prices beginning in 14. And if the copper prices were already declining in 14 and COVID, I'm sure a lot of you realized there was no demand. There was no demand for, base metals, ferrous, non-ferrous, any type of commodity. And this leads to declining in prices. So in an already declining environment, you see further declining in pricing acceleration for a country which has maximum copper, 60% export. It's a problem. Your export numbers go drastically bad. By November 20, Zambia's annual inflation rate climbed to 17%, its highest level in 4 years. Additionally, the national currency kwacha depreciated 33% against the US in 2020, creating more pain for Zambian consumers because it becomes then expensive to get some of the products. It's like rupee depreciating, right? When you say kwacha depreciating 33% against USD, it may not fit very well in our brains at times, but I think what is happening with rupee is exactly the same. Rupee is depreciating, and rupee hit its lowest level on Friday. I think it closed around 89.6, 89.7, if I remember that. That is the all-time low for rupee from the perspective of exchange rate. And let's just look at the number quickly. INR USD. Yep, slides to a new record low of 89.48 against US dollars. And we have never hit 90, but rupee is depreciating that fast, and it was a very, very fast depreciation, especially on Friday. I think you should look at the Friday's chart if it is available somewhere to you. It will tell you there was a very quick depreciation on rupee on Friday. And what this does, this creates a problem for all consumers like you and me if we are going to import products. And think about the country. The country is an importer of fuel. We import a lot of oil, and oil imports become expensive for us if we have to pay 90 rupees to a dollar. So depreciating currency is an issue to that extent. Zambia's total external debt had more than doubled in just 5 years, increasing from USD 4.8 billion to or 18% of GDP to 11.2 billion or 48% of GDP. Now, I don't know how much weightage should you give to these things, but it, this number looks, yes, very high, that it increased. However, when you look at US own debt to GDP numbers, you'll just laugh this out that okay, 48% is very reasonable because US has its own debt to GDP ratio of more than 100%. So sometimes I think these numbers should also be looked into context, but the idea is US is more stable as an economy. It has a lot of other things working for it. While Zambia is a frontier market, it's not even an emerging economy, it's a frontier economy, which makes the problem slightly more magnified. At the same time, external reserves fell. When we say external reserves, fell from 50% of debt to just 5% due to falling prices for its copper exports. This led to the inevitable default on external debt and consequent restructuring. Your foreign exchange reserves, if they fall, how will you make the payment of debt which is in foreign exchange? Right? So if our foreign exchange reserves fall, how will we make any dollar payments for fuel or for any other loan that we have taken from external entities? So, which is why a lot of people actively track what is happening to INR USD, what is happening to the forex reserves, how much decline is it there, what happens if people keep selling in the stock market like foreign institutions, because every time a foreign institutional investor will sell shares in equity market, they are going to sell it in rupees and ask for dollars because they will have to convert the rupee to dollar and take the dollar back home. So the more FII selling is there, dollar gets withdrawn from the Indian economy, which is why the government in general focuses on FDI and FIIs. That okay, we should have more FDI money. Dollars should come and should stay here for long term. FDI is long term investment. FII is short term investment. Quick example, which of the following statement best describes debt burden versus debt affordability measures? Debt burden measures are similar to leverage, indicating a government's relative solvency, while debt affordability debt affordability measures provides a measure of debt coverage. Looks okay. A higher interest to GDP measure is associated with higher credit quality, while a lower debt to GDP signals less risk. No, no, no. This is wrong. Higher interest to GDP, which means you are paying a lot of interest, right? And if you are paying a lot of interest, it cannot be higher credit quality. This is going to typically be lower credit quality, right? So this cannot be the right answer. Higher debt to revenue is associated with greater credit risk, while a higher interest to revenue ratio signals higher credit quality. Again, you cannot have high interest as high credit, right? So your right answer would be A. Debt burden measures are similar to leverage, while debt affordability measures provide a measure of coverage. Will you be able to pay? Coverage is always will you be able to pay? And burden is how much is your leverage? Now, in non-sovereign government debt, as we said, non-sovereign is all about agencies, government sector, banks, supranational issuers, regional governments. A lot of people will be non-sovereign in this category. How do you assess credit worthiness of non-sovereign entities? So when we say non-sovereign entities, which of the following statement best describes the relationship between local government and sovereign creditworthiness? Local government have limited jurisdictional powers and do not control or no control over economic and monetary institutions. I think this is the simplest giveaway. Local government has no control over economic decisions and RBI or economic institutions and monetary institutions. So this looks okay. Let's also read the others. All sovereign governments use a tax revenue sharing system across sovereign and local governments to ensure that local authorities meet their obligations. Not all, not all, right? So some of them will use this tax sharing, but not all geographies do it. Local governments with the power to attract and retain major industries and employers are often more creditworthy than the sovereign. No, they have the power to attract, but that doesn't guarantee that people will come and set up factories and industries in your state. The other problem is sovereign is more credit worthy because they can print money. The state cannot print money, right? So the right answer becomes A here. Okay, another question. Il de France, the regional government of Paris issued a green bond, the proceeds of which are used for investment, including eco-friendly construction and renovation of buildings, public transports to support sustainable mobility and renewable projects. The bond is backed by the tax and other revenue of the Ile de France. This bond is an example of general obligation bond, revenue bond, or an agency bond. Inputs. Now, please remember this will fall under a general obligation bond. Though the proceeds of the bond are used for specific green infrastructure development, interest and principal payments are backed by the tax, right? Because you are backed by the tax here and other revenues of the local government rather than any specific project revenue, right? So therefore, we are saying it's a general obligation bond. If this would have been backed by a specific project's taxes or revenues, we would have called it a revenue bond. And an agency and a non-agency bond is typically the word agency is used for quasi-government entities, right? Fannie Mac, Freddie Mac, and Ginnie Mae. And non-agencies, private entities. Another one, a special purpose Dana Infra National Berhad, a special purpose vehicle of Government of Malaysia, issued retail bonds for the purpose of financing mass rapid transport infra in Kuala Lumpur. Interest and payments are supported by cash flows of the MRT system and a credit guarantee of Government of Malaysia. This bond is an example of, in this case, you have a project. Remember, you have created a special purpose vehicle. So when we say a special purpose vehicle, we are largely looking at a very, very specific project. Again, in this category, you are backing everything based on the project revenues. Where is it? Interest and principal payments are supported by the cash flows of the project only. Because this is project specific, this is a revenue bond. You are getting your cash flows backed from a specific project. The primary source of repayment is the mass transit revenue. Thank you and have a good day. I'll see you next Saturday with the remaining portion on fixed income. Thank you.